The ratio covered call option strategy, how I trade it, some important notes about it, and why I think it is better than the covered call. And I'm going to walk you through an example at the very end. So, with that, let's get right to it. For those that don't know, this is essentially a part of my covered strangle strategy. We're just breaking out a specific segment and applying it to the people that like to trade covered calls, because a lot of folks like to do that, and that's totally cool. We're going to start with looking at a covered call for context. The assumption here is that you already generally know what this is, but if you don't, I'll give you a quick recap. A covered call typically means we're going to have the same overall delta potential for long and short deltas. So in this case, we have a 1-to-1 or a 2-to-2, reduced down 1-to-1. So this is long 200 shares of Tesla and short 2 calls. So what this means is we have a maximum of long 200 deltas from our shares and then a maximum of negative 200 deltas from the short calls. And that leads to this right here. You'll notice once we get to the max profit potential for the trade, which is going to be our short call strike plus whatever premium we received from the trade, and any incremental change over that going forward, as in if the underlying continues to rally, it doesn't matter. Our profit potential is capped at that maximum profit zone. Let's compare that to the ratio covered call. And as you'll notice right out of the gate, we have a slightly different risk profile where that same scenario that I was just showing you doesn't exist. We have unlimited upside potential. How does this happen? Well, it means that we're going to have more long deltas than short deltas. So in this same exact scenario, I am long 200 shares of Tesla. So that's our stock position down here, but I'm only short one covered call or one call against those 200 shares. So I have 200 maximum long deltas and negative 100 maximum short deltas. So it means I have 100 uncovered deltas. That is how we have unlimited upside potential. So what's the trade-off? If you've traded for any period of time, you know there's a trade-off, and here it is. We are unlocking uncapped upside potential. That's awesome, and I value that very highly. But the trade-off, we're receiving less money up front. So that means if for whatever reason we don't get the move we think we're supposed to get, whoops, sorry about that, then if we don't get the move that we think we're supposed to get, then we have less of a hedge to help us out. That's kind of a problem. So I want to walk you through an example on how this actually plays out in just a minute. But before that, I want to talk to you about the management of this trade. So my, again, underlying hypothesis here is that you already have something that you like to trade. You already have a structure to go around, pick the products that you like. You already have money management strategy wrapped around how you like to scale into things. If you don't, I'm going to talk to you about some of that in just a second. But I want to get into the flow so that you understand how this thing looks. And then I'm going to bring you over to an example that we're actually going to walk through live using the on-demand feature on Thinkorswim. So we're going to start in this case, rather than a cash secured put like we typically would in the covered strangle, we're just going to assume that we've already been assigned and we have long shares. Then we're going to offer the ratio covered call. I'm going to talk to you about the thought process behind what ratios and what expirations and deltas in just a second. But we're going to offer whatever we're going to offer for the ratio covered call, being short calls. Then we have a couple scenarios. Those short calls can be out of the money, in which case we just go back and start over again. Or those short calls can be in the money. Then we have two choices. We can either roll that position if we want to try and defend the in the money short calls. And that kind of brings us back up to this scenario. Or we can allow assignment where our long shares are going to be called away. So that is essentially allowing the long shares that are tied up. So in this scenario over here, if we have long 200 shares, but only short one covered call, it means we're going to lose 100 of those shares. And in that scenario, you still have 100 shares left. So If you have a big enough position, or if you choose to buy more shares, you can go back to the ratio covered call. You could turn it into a regular covered call at that time if you want, or you could flatten the whole thing at that point in time, which a lot of times is what I would do. And it depends on the trade hypothesis, because if we think the underlying is going to go up into perpetuity and we're still really bullish, then I wouldn't flatten. But if I made an original trade hypothesis, the trade moved in that favor, again, in line with my hypothesis, and then I reassess and I say, okay, it's made the move I think it was supposed to make, so it's time for me to flatten out and move on to the next opportunity. It really depends on your disposition towards the product. Okay, now I want to pivot us over to an example, and like I said, in order to do that, I want to use on demand. Right now, I have us back in time. It's the beginning of January, so this is 6 Jan 2023. So just the beginning of this year, because I actually had some positions on in here. So I thought it would be kind of fun to use the essential product that I did. Now, you'll notice as I fast forward time, there's going to be more of these dots, and some of them aren't aligned on anything. And it's because they're actually tied to the trade that I put on. So I'm going to zoom us out to 10 Feb real quick so you can kind of see the flow of the trade. And as you can tell, I'm purposefully testing this in a bullish environment, because that's really the main comparison I want to make between these products. So I'm going to take us back out, and we're going to go to 6 Jan, and then we're going to essentially establish a ratio covered call. So to do that, I'm going to buy instead of sell. I'm going to buy, and let's say I'm going to do 500 shares, and let's start with the covered call. So I'm going to do 500 shares, send those out the door. And most people, when they're selling a covered call, they'll kind of offer all of their options at once. So let's say we go out to like a 34 delta, something like that. And let's say that we're going to sell 5 here. So now what you'll notice, and I'm getting instant fills because it's all fake, this is paper. But if you'll notice, we have 500 long deltas and we have negative 500 short deltas. So this is a covered call, and our maximum profit potential is going to be realized at 130 plus the premium received, which is 540. So 135.40. And let's now fast forward and see what the result of this is. I'm just going to take us right up to expiration to save us some time here. And in this case, you can see that we had obviously an insane rally during the life cycle of this trade. So with that big old rally, this trade would be walking out at a overall P&L of $10,950, give or take. So this is showing us what this one instance would look like if we sold all 5 short calls at once. Now, a quick admin note. If you are trading the covered strangle, or I'm sorry, I use that strategy so much, I literally just say it. But if you are trading the covered call, one of the simplest ways you can optimize your performance is, instead of offering all 5 short calls at once in this scenario, would be to sell 1 each week. And it avoids this exact scenario where all of your short calls are out there and the underlying made this big move. Sometimes we can do that, sometimes we can't. But if you still prefer the covered call, that's what I would do to modify this. Now, that part aside, let's talk about the P&L of the trade. So as we can see, we made 41,825 on the underlying, and we lost 38.75 on the shorts. Obviously, we'll keep the premium we collected, and that premium we collected is an important note, because that's going to be one of the big differences between this and the other version of this. So in total, we collected $2,700 in premium upfront. Okay, cool. So let's go ahead and reset this whole shebang. We're going to go back in time to the same exact starting point, 6 Jan. And instead of the previous example where we had a covered call, we're going to do an uncovered call. Now, my typical preference for the uncovered call, as I was just highlighting, would be, instead of just selling all of my short calls in this expiration, it would be to ladder them out week over week. So something I might do to that example would be sell 2 in the 13 Jan, 2 in the 20 Jan, 2 in the 27 Jan, or 1 in the 27 Jan, or 0 in the 27 Jan. It depends on how you want to spread them out, but essentially I would want to make sure I have at least 100 shares uncovered. So But to keep it closer to an apples to apples comparison, I'm not going to do any of that. I'm going to pick our very same short call here. And instead of selling 5, we're literally just going to sell 4, maybe 3 if you're super bullish. In this case, I was. But again, to keep it to a closer non-preferential look back, I'm going to say that we sold 4. So in this case, I want to talk to you real quick about our selection process. If I'm thinking about whether it's a covered call or a ratio covered call, the closer I can trade, typically the happier I am. And it's because it allows me to get more cycles in. You're going to make aggregate more money that way than going further out in time. The other thing I'm going to try to do is find a balance. So let's say that I want to do this 35 days expiration. I want it to be above my cost basis. That's for sure. So my cost base in this scenario is 113.60. I want it above that. Okay. I could sell this 114. What's the trade-off here? If I sell the 114, I'm going to collect more money up front, but I have less capital gains potential. So what I mean by that is I can make, let's just call it $1,100 by selling the 114. But in terms of capital gains, I can only make 40 cents per share. In this scenario, I'm collecting much less upfront. I'm only collecting $540 upfront as compared to 11. But instead of only having 40 cents of profit potential, I now am allowed to run up to 130. So it's like $15, $16 plus. So you essentially are making a judgment call. Do you think something is going to run a lot? And if so, you might go further out of the money so that you are not getting stuck on capped upside potential prematurely. If you want to unwind the position, you've had it for a long time, it's already made the move you thought it should make, it's time to rebalance the portfolio risk, things like that. Maybe you sell closer at the money and accept that trade-off. I'm going to make more money up front, but if I do get a big run, I'm going to miss out on it. Totally up to you. You got to figure out what's right. So in this case, I'm just picking the same thing, and we did 4 instead of 5, and I'm going to do the same exact things. Last time, we're going to fast forward right to expiration. Last time we made about 10 grand, something like that. And in this case, we're at 17,125. So you can see it's a much greater return potential. This is an extreme example, to be abundantly clear, because this is a huge move to have in a short period of time. But if I'm trading something like a covered call or a ratio covered call, this is what I want to see. This is the scenario I'm attempting to expose myself to. So that's why I selected this one. The main trade-off here is if the opposite happened and we moved down, I just would have collected less money up front. So that's the trade-off here. You can either have much greater profit potential if you use uncovered, or I don't use uncovered because that's kind of synonymous with naked short calls, but in this case, they're covered because you have the underlying, but you're selling them at a ratio. You're just uncovering your upside potential. So the ratio covered call favors giving us upside potential, but it finds a balance between upside potential, but still collecting enough money up front. Because in this scenario, you essentially just collected $500 less because it's one lot less, but you unlocked significantly more profit potential if you get the big move that you think might happen. So it's all a judgment call based on your perceptions, but this is one of my absolute favorite strategies. And like I said, this is baked into my covered strangle strategy, which I'll throw a link in the video description below. If you haven't seen that yet, if you made it to the end, don't forget to like, subscribe, be an outlier, and I'll see y'all later.